Short selling regulations in the stock market. What is short selling? Short selling is an investment strategy that involves borrowing a security, selling it on the open market, and then buying it back at a later date, hopefully at a lower price. This strategy is used by investors who believe a stock's price will decline. To execute a short sale, an investor borrows shares from a broker and sells them immediately. Later, the investor must buy back the shares to return them to the lender. Why regulate short selling? Short selling is subject to regulation for several reasons. Market stability. Excessive short selling can contribute to market volatility and exacerbate downward price movements. Investor protection. Short selling can be a risky strategy, and regulations aim to protect investors from excessive losses. Market manipulation. Short selling can be used to manipulate markets and artificially depress stock prices. Regulations are in place to prevent such manipulative practices. U.S. short selling regulations. In the United States, the Securities and Exchange Commission, SEC, oversees the regulation of short selling. Key regulations include uptick rule. Historically, the uptick rule prohibited short sales of a security unless the most recent price change was upward. While this rule has undergone changes, it was designed to prevent excessive downward pressure on stock prices. Naked short selling ban. The SEC has implemented rules to ban naked short selling, which involves selling shares without first borrowing them. Regulation, Regulation SO imposes requirements on short sellers, including locating shares to borrow before selling short and promptly closing out failed to deliver positions. Margin requirements. Short sellers are required to maintain a specific level of margin in their accounts to cover potential losses. Disclosure requirements. Large short positions must be reported to the SEC. Conclusion. Short selling is a complex and controversial investment strategy. While it can provide opportunities for profit, it also poses risks to market stability and can be used to manipulate markets. U.S. regulators have implemented a variety of rules to mitigate these risks and protect investors. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.